Today, we will learn how to trade in tough market conditions and how to make clever price action decisions. We will get help from our beloved trading indicator for finding great trade zones. No more empty talks. If you're ready, let's do this. Let's have a quick talk about this Bitcoin setup by using our favorite tool, the ICT High Time Frame Candles Indicator on TradingView. When you apply this indicator, you can immediately spot multiple imbalance zones and quickly identify a good entry location. As you already know, we recently went over swing failure patterns. But if you carefully look at this 1 hour chart, you will notice at least 4 or 5 tricky and fake swing failure patterns showing up. That's the main reason I always encourage you to combine multiple imbalances with multiple swing failure patterns. This is really the only way to avoid or at least reduce those fake imbalance areas or SFP zones. Now, when we look at this SR flip area, the picture becomes very clear. Right here, you can clearly see a multi-imbalance and multi-swing failure point coming together. But it is not just the SR flip area. It also acts like a powerful amplifier because we have the previous week's high stink right there as well. And above all that, we have a super clear target. That's the PDH, the previous day's high area. So let's zoom in on this area and break it down further. First of all, right under the previous day's high, you can clearly notice that a parabolic liquidity has started to form. This formation creates an additional liquidity area that we can use as potential spot to hunt for trades. Later on, what really happens? The market structure breaks and the price dips down into this imbalance area. These areas stink right at the EQ point of between a premium and discount zone. If you look closely, you can clearly see the breaker block already here. This is one of our old and familiar smart money concepts. Then you took this trade. It turned out to be a clean setup, giving us a solid 2-to-1 risk-reward ratio. However, there is one issue with this trade, and it is something one of my students actually asked me about. If you look at the chart below, you will notice this trade took nearly 8 to 9 hours to fully play out. Now, as a day trader, it is perfectly fine to take just one solid trade per day because it is day trading. After all, you are a day trader, so that approach makes sense. I don't see a major problem with it. But here is the question. What if you are aiming for shorter time frames? What if you are more interested in quick scalping opportunities instead of holding trades for hours? So now let's zoom in the area even closer and break it down one more time. So, if you want to trade in shorter time frames, like under 1 hour, 30 minutes, or even as little as 15 minutes, the only real solution is to use closer targets along with tighter stop losses. This is the only practical way to get shorter trades done successfully. What you do here is actually quite simple. You just follow the trend. With every break of structure, you look for opportunities to take small trades, setting closer stop losses and closer targets. Just like you can see in these examples. But here is the challenge. When you trade this way, you run into big problems. That's because when you take micro trades, you are going to be stopped out quite a lot. The only way to balance this out is by making multiple trades during the day. You might need around 4 to 6 trades in a single session to finish the day with a positive net results. Let me break this down and explain it even simpler language along with some clear visuals. First, you need to find the direction of the market, the bias. You must have a bias. For example, let's say you spot an area with multiple imbalances and several swing failure patterns. That area becomes your entry zone, the area that possible reversal starts. At the same time, you also need to identify a clear target at the top. Now you have both a direction and a trading bias. This is the first step. So, as a regular trader, you might set up one big trade with a large stop loss as a day trader. That's the classic approach of taking one single trade per day as a day trader. However, since this type of trade usually takes a long time to play out, if you want shorter trades, basically scalping, you need to write the trend from your entry zone all the way to your target zone. And instead of waiting for one large move, you start taking micro scalping trades along the way, each with smaller targets and tighter stop losses. But as I mentioned earlier, micro trades comes with a major problem. You will get stopped out too often. So the only way to make this work out is by taking at least 3, 4, maybe even 5 or 6 trades in a single day, so that overall you can still achieve a net positive result with these micro scalping techniques. Completed the free trading course but still need more? My master classes teach liquidity, imbalance, and the market structure in detail. Combine them with forward and reverse trading using momentum superboxes and yo-yo cost average entry models. After that, you will master scalping with a one-screen free trading view indicator, a revolutionary trading system. Finally, you will learn to invest your profits using my 10-year swing investing with working agent system. Interested? Please see the video description.